Hello guys! We as investors have experienced a really rough start to 2022 and things could potentially get a lot worse from now on. There are a lot of things that does point towards a recession right now, and there are some worrying signs for us as investors. In today's YouTube video I will go over some of these signs and I will talk about what my personal view is and whether or not I think that we will enter a recession in either 2022 or 2023. So with that being said, then let's get started to talk about the current signs there is of a recession. The inflation is hitting a 40-year high and it is starting to get out of control. Buying conditions in the US are not looking good and they are the worst since the 1970s. And the general public in the US is starting to lose faith in the national economy. Goldman Sachs has also increased the probability of a recession in 23 from 20% to 30%. And other independent sources are saying that the probability of a recession in 23 is all the way up to 70%. The full consequences from the COVID-19 are not even over yet. We still have the supply problems, we still have high and so on. We haven't seen the end of COVID-19 yet, as China just entered a new lockdown phase in major industrial cities, which again can cause even more supply problems if cities with major harbors get affected by COVID lockdowns, or if production facilities get affected by COVID-19. On top of all of that, we also have the current Russia versus Ukraine conflict. The fully outcome of this situation is not yet known. However, there has been imposed some really serious sanctions on Russia that does have an effect on the overall worldwide economy. And some of these consequences are already starting to appear in the market right now. We've, for example, seen major falls in Russian currency, in the ruble, and we've also seen major decreases in the value of Russian companies. However, we've also seen a spike in the prices of energy and food, for example, and that does affect people in their daily lives. Companies are also being heavily affected by the situation and they have to navigate in a really difficult space right now, and they have to figure out what is right to do, whether it's going against Russia or making profits. And it's a really difficult situation for not just us as people, but also for the companies. The fully known worldwide consequences of this situation is not fully known, and a lot of it depends on what Russia decides to do next. But already now we can say that these sanctions imposed will have a consequence, not just on Russia, not just on Europe, but on the whole world. Now I'm going to talk more about the current market situation, and I will analyze a bit of these figures that are pointing towards a recession. The things that I'm going to analyze in the video are indicators that previously have been very successful at forecasting recessions. I'm also going to go over what I'm personally going to do with my own investments. But before we get into the video, I would highly encourage you to subscribe to my channel or like the video if you want to see more videos like this one in the future. It will help me out a lot if you were to do so. But with that being said, now let's get started. Before we start talking about the current market situation and the underlying risk of a recession, it is important to understand what a recession actually is, because not a lot of people actually know the definition of a recession. But a recession is being defined as 2 consecutive periods of negative GDP growth, which essentially means that the economic activity in a country decreases 2 quarters in a row. A negative GDP growth does usually imply a higher unemployment rate and less products are being produced, less products are being sold, and people are not spending as much money as they used to. So the economic activity in a country decreases when it is in a recession. Since the 1940s, we've had a total of 12 recessions, with the latest pandemic recession being the shortest, which lasted 2 months, to the longest being the housing crisis in 2007, lasting 18 months. And the average recession has lasted between 8 to 10 months. Now when we know what a recession actually is, then we can start talking about the possible signs of a recession right now. As I said before, there are a lot of indicators of a recession, and I'm going to talk about some of them that are actually happening right now. And these indicators have previously been pretty accurate when it comes to identifying a coming recession. The first sign of a coming recession is increases in the interest rates. Interest rate is basically the cost of borrowing money. If the interest rate is low, there is a low cost of borrowing money, and a lot of people are taking loans to buy new cars, buy new houses, and so on. But companies are also taking loans in order to invest into other companies, buy other companies, or expand their production facilities and so on. So a lot of money is being used in the society when the interest rates are low. Right now, the interest rates are increasing at 0.25% every few months or so, and maybe even more aggressive than that. However, hopefully not aggressive enough to cause a recession. Now we might be thinking that if increases in interest rate does cause a recession, well then why not just keep the interest rate low? And basically there is two reasons as to why the interest rate just can't be low forever. One of these reasons is inflation. If the interest rate is low for too long, well then the inflation starts to increase rapidly, and that is also a major problem. Another reason why the interest rate just can't be low forever is because the Fed can control the interest rates. The Fed, they can control the federal bond rate. However, the interest rate is actually determined based on the bond market, where we have a certain amount of buyers and sellers. So there is actually supply and demand, and that is what is setting the interest rate. Right now, the interest rate is still pretty low if we take into consideration what it has been previously in history. However, it has started to increase. And I don't think that the increased interest rate will cause a recession as it is right now. However, if they do decide to pump it up much further than it is right now, then there could be potential problems with the high interest rate. I do think that increase in interest rate will have an effect on high valued companies, but I don't think it will be the thing that causes the next recession. The next sign of a recession that I'm going to talk about is the inverted yield curve. The inverted yield curve is highly correlated to the interest rate. The inverted yield curve has correctly predicted 10 of the last 11 recessions there's been. So this is a very, very important thing to look at when you're trying to predict a recession. The inverted yield curve happens when the 2-year rate becomes higher than the 10-year rate, which is an indication that investors see more risk in the short term than long term. And this is one of the most common indications that economic growth is about to slow down. Right now we do have a flat yield curve, meaning that it is not inverted yet. However, it can happen. And if it does happen, well then it could cause a major problem. However, right now it is sort of like flat, and it can go either way. It can return to the normal state, the good state that we as investors hope for, or it can invert, which we don't hope for. So there is definitely a risk of this, and the risk of an inverted yield curve is actually higher to cause a recession than the interest rate is. Right now we have a flat yield curve, meaning that the investors, they are very unsure about the future and they don't really have high expectations for it. They are very unsure. However, the yield curve has yet to convert. It hasn't happened yet, and I don't think it will happen actually. But it is definitely something to look out for, because if this does happen, well then we will most likely enter a recession. The third sign of a recession that I'm going to talk about is going to be rates growth. The household reached a total wealth of $150 trillion for the first time ever. And that is due to the stock market and asset market growing at a fast rate, and due to the inflation. The average person got a wage increase of about 4.7%. And that might sound extremely good, but when you're taking the inflation into consideration, then it's not looking that good anymore. Because when you take the inflation into account, the average person has actually gotten a decrease in the wage in 2021 of roughly minus 2.3%. And that is a problem, because when prices are increasing more than the wages are, well, then we tend to spend less money. And less money causes less economic activity in a country, and that is a problem. The fourth indication of a recession is increases in energy prices. Energy prices have historically predicted recessions very, very well. And there is a reason for it, because basically everything that we buy has some sort of energy going into it, whether it's oil or something else. Everything we buy has some sort of energy going into it. When energy prices increase, the prices of everything being produced basically increases as well. It's also a problem for private people who have to spend a large proportion of their total income on, for example, warming up their houses. They also have to spend a larger amount of money on buying things, because there will be increases in prices when the energy price increases. So that, combined with, for example, lower wages, is a problem. It's also a problem when you're combining it with a higher interest rate, because the cost of borrowing money becomes higher and you have to pay more for everything that you buy. So that is the fourth indicator of a recession. So based on the 4 indicators of a recession that I've talked about, we basically have some problems, because we do have an increase in the interest rate. We have a flat yield curve. It has yet to invert, but it's flat right now. And we have a negative growth rate, which is a problem because people will now spend less money. We also have an increase in the energy cost, which again increases the spending. So basically a larger proportion of their total income is now being used on energy costs due to this increase in prices. So the signs of a recession is definitely there, and whether it happens or not is unsure. But when you're looking at the signs for a recession, there is definitely a high probability of a recession in either 22 or 23. So now when we've talked about the potential signs there is in the current market for a recession, it is important to talk about how the stock market is actually responding to a recession, because the results here will be quite shocking to many people actually. Based on this table here, we do see the periods of recession and the GDP contraction. Basically, we see that the largest GDP contraction was during the Great Recession in 1929 with a negative GDP of 26.7%. Based on this table, it is pretty safe to say that overall the GDP is of course going down when this happens. However, the GDP is not an indication of what the stock market is actually doing. And that is what I'm going to look at next. Table 2 is actually showing how the stock market has responded to these recessions. In column 2, we see the returns during the recession, which is negative for most parts. The largest negative return was the recent housing crisis in 2007, with a return of negative 35.5%. However, just 1 year after the recession, we start seeing extremely high returns, and it just keeps on going for the next 5 years. In fact, we actually see that all stock returns are positive 3 years after the recession. And that is actually indicating that investing during a recession might not be a bad idea after all, because the stock market has always historically recovered from every single recession there's been and reached new all-time highs again and again. There might be some of you thinking, well, I'm just going to invest during a recession and that's it. However, investing during a recession is actually pretty hard to do, because as I mentioned before, the definition of a recession is when we've had 2 consecutive periods of negative GDP growth. That also means that you only know you are in a recession after the recession has actually happened. You only know it after these 2 consecutive periods have passed. So if you're investing after you get the news that you are in a recession, well, then it might already be too late to buy the cheap stocks. And that sort of like proved the strategy that it might be a good idea just to keep on investing no matter what happens, because we could actually be in a recession right now without even knowing it. Now we've discussed the potential signs of a recession there is in the market, and we've discussed how the stock market is actually responding to these recessions historically. Now it's time for me to sort of like talk a bit about what I'm personally gonna do in the current market we are in right now. And for me personally, I'm gonna keep on investing as I always do, using the dollar cost averaging model, where I invest every single month into the S&P 500 index and other stocks if I feel like it. Right now, I'm sticking to sort of like a quote from Warren Buffett, who is an investor that I'm sort of like looking up to. And he basically says that be fearful when others are greedy, be greedy when others are fearful. And that is sort of like the market we are in right now. Even though there has been a recovery, people are not over greedy right now in the market, and the market is sort of like neutral right now. So I just keep on buying, because I don't think that the market is overpriced. I never try to time my investments based on macroeconomic activity, because macroeconomics will always go up and down all the time. Basically, I'm always buying on the assumption that my companies are performing in the way in which I believe they should be. If I'm not satisfied by the returns that my company is making, well, then I sell them and buy a new company. But I never buy based on macroeconomic situations, because they change all the time. And since I'm not able to predict the future, I just keep on buying. And eventually I do think that the stocks will reach an all new time high, even though we might enter a recession in 23. So basically I'm going to keep on doing what I've always been doing, just buy every single month, be consistent with it, and just keep on investing into the market, because I do think that 10 years from now, the market will be higher value than it is today. And that's the assumption that I'm buying under. Lastly, I want to say thank you for watching the video. If you liked the video and want to see more videos like this one, then please press the like button and subscribe to my channel. It will help out a lot if you were to do so. So thank you for watching, and see you in the next one.